Good afternoon, ladies and gentlemen. Welcome to the Inspired PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. Company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Mark Dickinson, CEO, and Paul Connor, CFO of Inspired PLC. Good afternoon.
Good afternoon, ladies and gentlemen, and welcome to Inspired PLC. I guess as a business, we've been listed on AIM since 2011, so this isn't a new story, but many people, I suppose, will not be familiar with the evolution of the business over the years. Ultimately, we've gone through a transition from founder owners to professional stewards of capital in terms of Paul Connor as CFO and myself, Mark Dickinson, as CEO. And ultimately, that journey has allowed us to transform now into a specific investment opportunity that really speaks to the emerging themes of net zero carbon and ESG. We're one of the few companies on the London Stock Exchange, one of the 101 of them who have received the Green Economy mark in recognition of our work in relation to the green economy. And ultimately, the transition we've been on has really led to development of a very strong board, which ultimately drives the company forward. So if we look at meeting the board, gender diverse, Richard Logan, chairman, AIM professional, been around for a long time, a steady hand on the tiller. Sarah Flanagan gives us a non-exec with strong tech and energy experience, which is very rare to come by. Sangeeta, a network to die for, sits on the board of the QCA, very strong from a government perspective. Diane Walker, audit background, heads our audit committee. So as a group, the evolution of it to a professional company, we've been very excited about in terms of managing this transition. If we look at our investment register, 75% or more than 75% held by institutions. That gives us a strong base, but probably what we haven't done so well over the years is really communicate with the retail investors. So this represents our first foray of what will be more over time to actually make sure we're communicating the story to retail investors as they start to understand the opportunity. If we look at kind of the takeaways from today's presentation, hopefully you'll leave the presentation understanding what type of business we are, the size and scale of our opportunity, where we are to date, our segments and how they grow organically, how our growth engine works, the buy and build opportunity we have in the marketplace, the breadth of our proprietary technology, and the exciting opportunity offered by ESG. So what's our purpose? We help corporate businesses deliver net zero and respond to climate change whilst controlling their costs. And that part about controlling their costs is really important. So ultimately with COP26 and all the news flow in relation to ESG, we can see all of the favourable market dynamics that make this a hot topic in society at the moment. And there's lots of ideology and there's lots of people with solutions, but we're one of the few companies in the marketplace that actually have to deliver those solutions. We have to do it for ourselves. So when we work with our clients, we're effectively delivering pragmatic, cost-effective solutions that help them deliver net zero, that help them respond to climate change, but also do it in a cost-effective and practical way. And that's a key differentiator. We do that through three divisions. Our energy division, where we help consumers manage their energy cost equation. Our ESG division, where we help them make their ESG disclosures as demanded by their investors and wider society. And our software division, which basically underpins the technology-enabled service we provide. So what type of business are we? We're a technology-enabled service provider. We look after 3,600 corporate businesses in the UK and Irish markets. In terms of the size and scale of our customer base, we represent 6.7% of the corporate energy consumed in the UK. We are not an energy supplier. We're a company that supports corporate businesses in managing that cost and environmental equation. We're also the player of scale in the market. So this is a highly fragmented market. There's many people offering services, but we are twice as big as our nearest competitor, as independently assessed by Cornwall Insights. So why do we exist? What's our raison d'etre? How do we help customers? If we think about every business in the country, each of them is a prospective customer. So whether you're in manufacturing, or in retail, whether you're in the public sector, whether you're in hospitality, everybody with a substantive energy spend is a prospective customer of ours. And things start really with helping them place that energy supply contract through our energy assurance division. So every business in the country must have an energy supply contract. It's non-discretionary. They renew every couple of years, and ultimately, to be able to decide whether you're being offered the right thing from your supplier, a corporate business needs subject matter expertise to be able to make that decision. Normally, it's not worth those customers maintaining that subject matter expertise internally, so they'll use a company like ourselves to do it. So let's imagine one of our customers, they happen to be a major retailer. They've got 650 stores in the UK, and they spend £50 million a year in energy. So the first thing they need is an energy supply contract. In order to get that energy supply contract, we need to collate thousands of pieces of data for them so that the costing can be achieved and the offers procured from the suppliers in the marketplace. We support them with that process. We do all the work, all the analysis. We help them run a professional buying process, and ultimately they select an energy supplier. Once they've selected the energy supplier, if they've got 650 premises in the UK, the very next month, 1,300 invoices arrive. And ultimately those invoices, the consumer needs to understand whether they're correct or not. It's sad to say that in the UK market, the average invoice error from an energy supplier can be around about 6%. Clearly, the majority of them are correct, which means the ones that are incorrect, you have really big errors on. So companies have a duty to assure themselves that their energy invoices are for the right amount. So rather than those 1,300 invoices arriving with our retail customer, they come to us. We digitize them. We store them in a tax compliant way. We recalculate all the costs from first principles to check what's right and what's wrong. Any queries we raise and manage with the supplier. And at the end of the month, we squirt all the answer into an accounts payable file, which we send off for the major customer to put into their energy account, their accounting systems. Now, typically for that kind of service, if someone's spending £50 million a year in energy, they're going to pay us maybe a fee of £100,000 a year. So that's where it starts. We've started off solving complexity for a non-discretionary event that recurs. We've then started dealing with the accounts team in a routine monthly process, which means we quickly then get asked to help with the budget setting process, managing the accruals, and very quickly through the energy assurance services, we have a C-suite relationship with our client. If that client happens to be private equity owned or listed, or they've got substantive customers that have got ESG requirements, they have a legal, in some cases, or a regulatory obligation to make ESG disclosures. Those ESG disclosures can start with SECA, the Streamlined Energy and Carbon Reporting Initiative, and ESOS, the Energy Savings Opportunity Scheme. In April 2022, for some of the larger customers in the marketplace, TCFD will come in, the Task Force for Climate-Related Financial Disclosures. For our clients where we're providing all the energy assurance services, they have all these obligations. It uses a lot of the same data that we need to use to provide our technology-enabled services in relation to assurance. So it's not a big step then for that customer to start to use us for their ESG disclosures. And maybe at that stage, we've actually, by providing those services, we've pretty much doubled our fees with that particular client. And now we're kind of well embedded at C-suite, not just in relation to the financial side of the business, but normally with the executive team and the environmental and sustainability teams within the organisation. So once you're assured that you're buying professionally and you're accounting properly, once you've actually you're making your regulatory disclosures and you understand you're complying with the law, all the things that we're adding value to our clients on, the next thing is, how can we reduce our energy consumption? How can we reduce our carbon emission? In this situation, we're providing services like carbon action programs, our energy management as a service solution, and optimization services, which really help put efficiency equipment into the organization. They will work on putting in renewable investments, storage, etc. Now, ultimately, there's many organizations out there trying to help clients with this problem, but we get to do it from the status of being a trusted advisor. And why does that work? Well, for our retail customer, they might be dealing with some really big companies who provide energy efficiency solutions in terms of equipment, producing kind of switches or relays and that sort of thing, or LED lighting. But ultimately, those companies, they're buying a what we'd call a commoditized product. So they might spend, the retailer might spend £5-10 million with companies like Schneider Electric or Siemens or those kind of organizations. But with us, they're only spending £200,000, but we're looking after a £50 million problem. So the companies that traditionally provide those energy efficiency solutions, they're only speaking to a junior buyer within our organization. Whereas for us, we're already speaking with the C-suite. So the cross-sell of energy efficiency, carbon reduction solutions into our clients from the trusted advisor status we've already gained by providing assurance services and ESG disclosures really becomes a much more straightforward sell and a very strong cross-sell opportunity. At this stage with our retailer, we've doubled our recurring fees per year, and now we may well be delivering efficiency projects which are worth on average £1 million a year over a 5-year period. So you can see how the model scales. We have a non-discretionary recurring call to action. We have regulatory and compliance drivers. We meet those needs. It's recurring. It's regular engagement, moving up to C-suite. And then all customers, because of the net zero agenda, because of having to manage the response to climate change, they now have a drive to remove carbon and energy from their processes. And we're in a prime position to be able to help with that and have a proven track record of cross-selling those services in. As I mentioned, we're a technology-enabled service provider. So ultimately, we must have proprietary technology which underpins our energy assurance business, our solutions business, and our optimization services. Because we have to make that investment in technology, and energy is well known as being a laggard in that respect, ultimately, we've built that in a way that we can provide it to other service providers to technology enable them. What that means is we have access to a SaaS business which actually monetizes our software, not just from allowing us to provide our services, but also for allowing other people to provide services to consumers where we may not naturally be able to get the relationship. So if we think about that overall, ultimately, our estimated market size for all of these elements of the business, it's a £2.5 billion opportunity in the UK. So if that's why we exist, Paul's going to walk you through where we are today.
Thank you, Mark. So since the IPO of the group 10 years ago this month, the group has achieved 31% CAGR revenue growth and 25% CAGR adjusted EBITDA growth. And this has been delivered through sustained organic growth combined with the addition of strategic and complementary acquisitions. 2021 is a milestone year for the group in terms of financial reporting, in that it marks the first year in which the group are reporting on the new segmental structure, which Mark has just set out, which is energy assurance services and energy optimization services, which fall under Inspired Energy, ESG disclosures, ESG division, and software solutions being the fourth segment. Reporting this way provides investors with greater visibility of the financial performance and underlying growth drivers of the group. This is particularly as important because the segments have fundamentally different revenue models with different profit margins and different expected future growth rates. So a question we've had from investors over the last few years is, are the group margins diminishing? And the simple answer to that question has been no. It's been as a result of a change in revenue mix, which this additional visibility will make very clear. Furthermore, the additional visibility enables investors, analysts, and stakeholders alike to value the segments individually, noting the premium values we've seen attributed to peers in the energy optimization and ESG space over the last year. So we start with the Energy Assurance division, which has been core to the group since IPO and currently serves the 3,600 commercial customers across the UK and Ireland. The Assurance division maintains attractive EBITDA margins, and prior to 2017, the group focused primarily on the cost side of the energy client cost equation. Assurance services contributed in excess of 95% of group revenues. Since 2017, the Assurance division has grown significantly in absolute terms through acquisitions and organic growth, sustained organic growth. However, due to the service offering broadening to support the clients with the entire cost equation, in percentage terms, the Assurance division contributed 55% of group revenues in the first half of 2021. In terms of looking forward for the Assurance division, we expect to continue to deliver organic growth rates of 6 to 8% per annum and maintain underlying EBITDA margins of circa 40%. Since 2017 and that change in revenue mix, the optimization division has grown significantly, again, both through organic and acquisitive growth. And in the first half of this year, contributed 40% of group revenues. In terms of future expectations, we believe there's an opportunity in the optimization space to deliver significant organic growth rates, double-digit, 15 to 20% per annum in the following years. Due to the cost to serve in this area, so an example would be, Mark referred to a cost of consumption reduction project, large-scale demand-side reduction project. You have the cost of the installation of the project, which would flow through your cost to serve. So naturally, it has a lower margin in the Assurance division, with the underlying margins in this space running at circa 20%. Our newest division, the ESG division, contributed modestly to group revenues the first half of the year, following our organic entry into this space in 2020. We continue to guide prudently on expectations for future performance of the ESG division, but remain excited by the potential for the group in this area, with our belief that the ESG division presents an additional market opportunity of circa £43 million of revenue in the UK for the group, with the margins in this space comparable to the consultancy assurance margins we see of circa 40%. The Software Solutions division, which remains a relatively small amount of group revenues at 4% in H121, but from this base, we again see potential for significant organic growth rates from the Software Solutions division, where we believe we can deliver 25 to 30% organic growth per annum, with EBITDA margins you'd expect to see within a software business.
So what I want to do now is really bring to life for you our organic growth engine. How does that work? And a neat way to communicate this is to really explain our flywheel. So if you think about a business that's starting to grow, you've got a really heavy flywheel and you've got to push really hard to start to make it work. And it starts to turn a little bit and you start pushing it in the right place. It turns a bit faster, a bit faster, a bit faster. And then it gains a life and a momentum of its own. And that's really how you start to accelerate that compound organic growth. And over the years, as we've transformed, we've reached a level of maturity now and being the player of scale in the industry where we feel very comfortable being able to share the underlying, if you like, secret sauce of that flywheel so investors can understand it more clearly. So the first thing we have is units of opportunity. If you think about what we do, we look after energy, we look after buildings, we look after equipment, all around society for corporate businesses. So we can think of those as our units of opportunity, and really they're points of carbon emission. And so the first way to get our flywheel moving is to really get access to work with as many units of opportunity as possible. How many buildings can we get to work with in some way? How many meter points can we get to work with? And just keep increasing that over and over and over again. And that's going to start to build your momentum. So we do that with a field sales team from the energy division. and a field sales team from the ESG division. They're going around the market. There's only so many corporate customers. We know who they are, and ultimately we're building relationships with them and responding to tenders as they require services, or making proposals when they have a specific requirement. We then have a very specialist division in terms of PCMG, which we acquired a couple of years ago, which provides forensic audits in relation to how businesses are recovering money from energy suppliers. Are they paying the right amount? Has there been an incorrect configuration on a site, which means there's been an overcharge, and we recover that cost on behalf of the customer. Now, what really helps us there is when we're doing that, we gain a lot of goodwill. Also, at that point in time, the customer receives a windfall gain. So that windfall gain, ultimately, when we're working with them, it's not a difficult conversation to then to point out, hey, look, you could use some of that to really start to deliver your net zero journey. And so you start to create a virtuous circle in terms of access to those units of opportunity, those carbon emission points. The fact we give our software to what are effectively competitors, or sell to our competitors, they have their own customers, which are carbon emission points, effectively, units of opportunity. And ultimately, they don't have the capability to sell all the range of services that we have. So we can provide those on a white label basis. Again, getting access to more carbon emission points where we have the opportunity to generate revenues and make a difference. Acquisitions of businesses that focus on energy assurance, which we've done many of, they also bring us more units of opportunity. So in 2021, we've acquired BusinessWise, we've acquired GEM, we've acquired LSI, and all those businesses as energy assurance companies or focus on energy assurance solutions, they give us access to more of those units of opportunity. SDG.me is a new piece of tech, our first foray into delivering an ESG solution. And ultimately, we provide that free to our customers or prospects, and that gives us, again, a chance of getting access to more units of opportunity. And finally, our investors, because our service, as our position as a technology and service provider is somewhat unique, our investors will refer us to companies in their portfolio where we can help them solve the societal problems of net zero carbon and response to climate change. So once we've got lots of units of opportunity, what do we do for them? Well, that's back to the hierarchy of needs I showed you when we start doing the energy procurement contracts, where we manage the price equation, which has got a energy cost equation, which has got a price and a consumption side. So we provide the energy assurance services and the energy optimization services, and then also providing our ESG disclosure services. That's where we build the relationship with the customer, a recurring demand where we gain that trusted advisor status. And what we want to do is find more and more of those things to do so that we're solving every need that relates to net zero carbon and ESG, so that ultimately the client doesn't have to invest their time and resources being distracted on doing some of those administrative processes. Once we're doing that and we've gained that trusted advisor status, we've earned the right to make a difference. And ultimately, that's when we start to really deliver to our purpose, which is all paths start with that carbon action program, a roadmap to deliver a net zero strategy. That's going to have an element of behavioral change to it. It's going to have an element of energy efficiency to it, an element of carbon offsets to it. And we're going to help the customer with all of those things. So we're also going to sit there and put acquisitions in place that give us more capability in these areas. So when we're acquiring in the optimization space, in the carbon efficiency space, we're effectively doing it so we can do more things to actually remove carbon from those carbon emission points that we've gained as units of opportunity, that we've earned the right to be a trusted advisor on by doing all the admin and data work that's required to maintain them so the company can meet their assurance and disclosure obligations. Once we've earned the right from an energy side, the next step is that ESG isn't just about energy and environment. ESG is also with the S part of the wheel. So from that point of view, doing acquisitions where we can start to actually make an impact, because delivering disclosures is something companies have to do, but in its own right, it doesn't achieve anything. What's important is the impact the companies make in relation to all the elements of that ESG wheel. And that's something that we support them on. And if you think about kind of further opportunities for acquisitions, building more and more of those things increases the rate at which the flywheel turns. Next is the technology enablement. So we're doing all those things. We're getting those new solutions, both at the assurance and data management side and in the making a difference side. And what we want to do is make sure that all technology enabled. As we do that as well, we make sure that technology is available independently on a SaaS basis to other service providers. So we increase the number of units of opportunity we reach. And then finally, drive cost out of the process. So implement robotic process automation where you can. Where you can't do that, we have a low-cost operations centre in Mumbai, which most importantly gives us a strong time difference so we can reduce our SLAs and increase our efficiency of service to the client, because we can be doing some of the work that needs to be done at a time when kind of our clients are sleeping. So once we've done that and we're driving that cost down on a continuous basis, the flywheel's turning faster and faster. And guess what? We've generated some more money that we could invest in getting some more units of opportunity, so on and so forth. So if that's the way that the organic growth engine works, this space also affords us an absolutely fantastic buy and build opportunity due to the fragmented market. And Paul's going to walk you through that.
Thank you, Mark. So M&A has been a key strategic focus and remains a key strategic focus of the group, having successfully completed 18 acquisitions since IPO, deploying an average of 15 million of capital per annum since 2017, which not only has demonstrated our ability to transact, but also to successfully integrate. The energy consultancy space remains a highly fragmented market, presenting attractive EBITDA multiples on which we can acquire assets. In terms of firepower from a balance sheet perspective, leverage appetite, etc. As a board, we've always said there's no desire or need to over leverage the business. The business is highly cash generative. And we're comfortable with net debt of circa 2 times net EBITDA to net debt of circa 2 times on day one of the transaction, but reducing as the acquired business begins to contribute to profits and in turn free cash flow of the group.
So what we'd like to do now is bring it to life a little bit. As we said, we're a technology-enabled service. So we'd like to give you a brief introduction to that technology, and we'll do that by virtue of a short video. So what we're going to do now is show you the software that actually underpins the technology-enabled service that we provide. So Unify is ultimately our proprietary systems, and the way to think about them is an app store, if you will, that provides all the tools and functionality that allows a company like Inspired to provide its services to its clients, and also for those clients to be able to interact with those services. You can think of it like an app store. So we have currently 15 modules that are deployed. We have another 6 in development between now and the end of Q1. And that just becomes a machine that starts to solve more and more problems in relation to energy assurance services and ESG disclosures. I won't dwell on the detail of the software too much, save to kind of show you maybe where it all began with Caro. So Caro basically is the result of us buying the Systems Link and STC businesses some years ago, and ultimately as we've modernized that software, the result is Caro. So for each of our customers, what they can see is a dashboard of their estate. They can see league tables of numbers of sites, and ultimately this is going to be the software that really manages their energy accounting process, allows them to assure themselves they've paid the correct invoices, and to make sure that they've managed their consumption correctly. So obviously you can drill down to individual site levels, and at this kind of level, a particular employee of a company could see things like all the invoices, all the charges. They could see time of day heat maps. They could see carbon emission reports, etc., etc. All the things that you need to do to manage your energy estate. And this is also the tool where we actually do most of our data mining. So when we're looking for optimization opportunities for clients to really reduce their energy consumption, reduce their carbon emissions, we're going to data mine the information in here to find those insights, identify those projects with the appropriate return on investment, and help the client go through a process to be able to implement those and really deliver that net zero journey. The unified system does a whole lot of other things, and just by way of example, market prices. So ultimately, this system would give live market trading prices. The client can also sit there and look for price history. And I guess this really kind of starts to bring to life the challenges that customers are facing at the moment in relation to the current energy crisis that we're observing on a global basis. So I guess kind of when we look at these modules, they all provide a number of different services. I guess one of the ones to really highlight now, though, is our first ESG related module, which is SDG Me. So an increasing challenge that executives like myself and Paul Fuller have is that it becomes part of executive remuneration that we need to demonstrate how we are delivering ESG and processes within relation to the UN Sustainable Development Goals within our organisation. And so what we've done is build a tool that actually allows us to look at that in relation to the activity of our employees. So if we think about it in terms of the actual process, what we have is an app that's been developed. That's available to all our employees, and it allows them to think about their activity from three perspectives. For Inspired, we have that confidence of work, play, and home. And those different perspectives really allow them to reflect on things that they could do to help the SDGs. And as and when they do them, they might choose to record that. It will show which SDGs are improving, and it will record any carbon benefits. And so that can be done effectively over and over and over again. Now, if they want to understand more about SDGs, they can engage with individual ones and also see how their behaviours comparing to the average saver in their organisation for the activities they've done. You have a full results page, which is going to effectively show you all of your activity and what you've been doing in relation to the SDGs over the week, month, or year. And I guess what's really different about this is it's the only tool out there that can actually sum the answer to a particular company or a particular set of clients or a particular set of users. So you can actually record the answer and make a disclosure. What it's also got is a moderation function, which is going to mean that when people are down the pub showing their kind of friends, actually those kind of actions which perhaps not meant to occur, meant to be recorded, they're going to be moderated out. So ultimately the company can say, this is my disclosure that I'm really confident in. What's really neat about this, it's a tool that we give away free to our customers, which really is going to allow them to demonstrate their engagement with the SDGs and make a difference. From our side, what it does, it's another way of embedding our service in with the customer and making sure we get access to those units of opportunity, those carbon emission points, so we can provide services to make a difference to the clients. So just to kind of summarize then, having hopefully given insights how the technology works and the kind of modules, we now have quite a neat machine for just building more and more and solving the issues that customers have. I guess what are our takeaways from today? You've got a business that operates in a market with exceptional macro drivers. Every corporate business we meet is a potential customer. They've got a non-discretionary call to action that requires subject matter expertise to solve. We deliver that as part of technology-enabled service. Once we do that, we move into an energy accounting process, which allows us to manage their data and make sure they can account for their energy correctly. There's regulatory and legal obligations, and increasingly so coming through from an ESG perspective, whether it's legally generated from investors or even we've got smaller customers, if they have customers in their supply chain which require ESG submissions, they're now making more and more demands on the supply chain companies. So ultimately, supporting clients in making those disclosures becomes a really important part of the service. That gives us trusted advisor status, which allows us to kind of work and earn the right to remove that carbon from the carbon emission points. And clearly being able to provide a SaaS model also helps from a kind of software perspective. It's a 2.5 billion, excuse the kind of typo there, a 2.5 billion opportunity and a high fragmented market. We've got a strong organic growth engine, and I've hopefully brought that to life for you. We've got a buy and build thesis where we've got a strong track record deploying capital, integrating it effectively, and delivering a strong multiple arbitrage against that. Our move now to be able to report in a more transparent segmental basis really gives investors an opportunity to make a much more informed decision about the value of this business, noting some of the valuations in the marketplace for some comparable businesses to our kind of segments, and a proven cross-sell opportunity. The logic of how this fits together is really neat, and it's not a concept we've already started doing it. What we've got is a great universe of opportunity. I think we currently stand at around about 250,000 meter points in the business, probably representing something like 80,000 buildings. And that's a lot of surface area to go at. So we do that across those three divisions: Inspired Energy, Inspired ESG, Inspired Software. And if you're an investor who's looking for exposure to the emerging and very topical market themes of net zero carbon and ESG, then Inspired PLC offers an interesting way of being able to do that and obtain direct exposure to that thesis. Thank you very much.
Fantastic. Thank you very much indeed, Mark, Paul, for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Mark, Paul, perhaps before we go on to some of the live questions that we've had through, we did have some pre-submitted questions. If I may, I'll just read these out. The first one reads as follows: please, could you outline your dividend policy?
Yeah, absolutely. I'll take that one, Mark. So we've always considered ourselves to be a dividend-paying stock. We're highly cash generative in terms of the business model. We've adapted a progressive dividend policy in line with earnings growth since IPO, noting that post the onset of the pandemic in March 20 last year, we subsequently, in terms of short-term cash flow measures, we subsequently cancelled the FY19 dividend, which would have been paid in July 2020, reinstated the dividend at the next opportunity, which was the interim results 2020 in September, at which point we said we would take a relatively cautious approach in the immediate term, in that we said dividend cover will be at least 3 times, but we would look to return to growing the dividend in line with earnings growth and return to that progressive dividend policy we'd adopted pre-pandemic as soon as feasible.
Fantastic. Thank you very much indeed, Paul. Second question we've got here is, with energy prices soaring this year, how's this impacted the business?
Yeah, so I guess kind of as a business, we have no exposure to energy prices. And that's a really key thing for everyone to understand. Our work is to provide services to help clients actually manage their energy costs, but our revenues are not linked to the energy price. So ultimately, we are getting a fee for our service. And from that perspective, they don't directly impact our financial performance. Having said that, volatility in the market, I suppose what it does do is it reinforces the need for our service and the need for people to be able to actually have companies such as ourselves provide support in this area.
Fantastic. Thank you, Mark. And the final pre-submitted question we have is, you have been inquisitive over the past few years. What type of acquisitions are you targeting now? And are you looking at expanding outside the UK and Ireland?
Yes, I mean, I guess as an organisation, we already have clients who are outside the UK and Ireland. So if we pick up a large customer in the UK that's multinational, they will often ask us to look after their European portfolio as well, for example. So we do that, but we tend to use kind of partnership service providers on the continent. So from that point of view, I guess kind of the idea of looking further afield there'll be an opportunity to do that in due course, and we already have clients there. I think in terms of where we're focused now, people will note if they read through our recent RNSs that we've just done a strong program of acquisition in relation to energy assurance businesses, which was really about adding those units of opportunity I mentioned. So we've done 3 acquisitions to really push that agenda. I think going forward at the moment, we remain acquisitive. We remain kind of with capital to be acquisitive, and I think you'll see us over the kind of coming period focusing more on optimization service businesses where we increase our capability to remove carbon from society. And by that, I mean kind of actually provide services which will put in more efficient equipment and solutions. And then I guess also on the technology side, so we can see areas where we won't go and buy aspirational tech, which is kind of not making money. We tend to buy mature tech where there's kind of EBITDA being generated, and then we'll integrate that and improve it, as opposed to something aspirational. So what I would say, pragmatic tech acquisition where kind of actually it makes sense to do so.
That's great, Mark. Thank you. That does conclude the pre-submitted questions. We have had a number of questions submitted during the meeting itself. So if I may just ask you just to click on that Q&A tab where appropriate to do so. If I could ask you just to read out the question and give you a response, that'd be fantastic. Thank you.
Yeah, absolutely. So if I take a question from Simon C, similar to a question as well from Mazin about recurring revenues, nature of the revenues, future visibility, and the part of Simon's question there in terms of focusing on ESG and what could hold back the potential growth in this area. I'll let Mark pick that a bit up. But if I take the point around recurring revenues, visibility, etc. first. So I guess in terms of recurring revenues, if you think across the 4 segments, pretty much all our revenue in the assurance, software, and ESG divisions are recurring revenues. The optimization division, we would say the recurring element of that revenue will be kind of 20 to 25% of the optimization revenues. In terms of visibility, so at group level, if you sum that up by contribution by area, that's 70% of our revenues are recurring revenues. In terms of visibility, future visibility over the next 12 months, we start each year at group level with 75 to 80% of our revenues effectively contracted and secured. So that's the level of visibility we have over the next 12 months. The assurance division and software division have greater visibility into 12 months and beyond, which is that comes through our KPI, the order book that we've published each reporting period. Optimization has great visibility in terms of the next 12 to 18 months in terms of contracted revenues, but doesn't have the same visibility as, say, the assurance business beyond that point in terms of what's contracted, albeit in terms of case study contracts. And the large-scale demand-side projects can run for 3 to 4 to 5 years. But in terms of what's contracted at the start of each year, that's where I say it doesn't necessarily have quite the same level of visibility. And when I talk about those percentages, that's pre-renewals. So there's no assumed renewal rate in that, because I think another part of Mazin's question was about churn and typical length of contracts. So in the assurance division, we have typical average contract length 24, 26 months, and retention rates run at about 85%. So that's those rates I talk about in terms of 80% visibility. That's there's no assumed renewal rate built into that. Do you want to pick up the ESG bit, Mark, of Simon's question?
Yeah, absolutely. So I guess kind of in terms of ESG, it's a really interesting space in terms of what we're finding so far, because we're not finding anybody else who's a particularly technology-enabled service provider in their approach to it. So if you think about what's out there, there's lots of strategic advisors, and there's lots of people trying to add value at a board level in terms of this is what you could do, etc., and this is how you can maybe present your answer. You might have some other design companies who write annual reports, having some ESG consultants on board saying this is how you should explain ESG. But apart from being potentially a little bit expensive, those kind of solutions, ultimately, once those advisors at strategic level have left, there's no answer. The company's still got to go and find a way of delivering a disclosure, which is actually their obligation. in response to this, a number of companies have provided software solutions to it. So there's quite a large SaaS market in purported ESG solutions. Now, we've reviewed most of them, and actually I would struggle in my own mind to kind of really recognize something that's solving the whole problem. Everyone solves about 70% of it. But the key challenge is, even if an organization like our retail consumer went and actually bought this kind of software, they've got nobody in their organization with resources to use it. And actually using that software, as much as people spout on about AI and that sort of thing, this is really unstructured data. And it needs someone who understands the data to actually get it into the system and then check what's coming out makes sense. So when we go to customers and we say, just like we do in energy, look, there's a big piece of data work to do here. It requires some understanding and expertise in that data to be able to get it to the right answer. They're just delighted that ultimately someone is actually solving the problem. So it's early days. We're kind of significantly ahead of plan in relation to this. And in terms of the customer experience we have, both with our existing customers, but more importantly, bringing other customers to the group where maybe they've chosen not to use us for energy, actually we're finding a nice bit of traction there as well. So at the moment, I think kind of we're enjoying the fact that ESG is very complementary to the energy assurance services we provide. And in terms of our approach to it as a technology-enabled service provider, we're not finding many others in the marketplace. Certainly, I'm not having a competitive price discussion because there's an alternative proposal on the table.
Okay, Mark, there's a couple of questions there. So for yourself, Mazin, around new business wins, new business rates, win rates on these tenders.
Yeah, so I mean, I guess kind of if you look at how businesses comes to the organisation, as the player of scale in the market, any substantive client or most substantive clients are actually going to come to us and ask for a quote, even if they're just price checking. So basically, we do get quite a lot of inbound that these days. Of that, I would say around about 25-30% is what I would call formal RFPs. So we run a professional bid writing team where they're going to be dealing with both public sector bids to kind of OJU standards or the kind of new UK standards, and ultimately providing professional responses to kind of RFPs from large blue chip organisations. On those, typically for renewals, we'll run a kind of 85% retention rate across the business on average. And that would be the same whether we're getting bids or just direct renewals going via the account manager. In terms of new business bids, it can vary year to year. We're finding at the moment that in a post-COVID world, there was a bit of a period in the first half of the year where I would say bid activity dried up a little bit as people were still focusing on bringing their businesses back online. We've seen a surge in bids, so the bids team have never been busier in recent months. And I think at this year, the current stat would be we're actually achieving a 50% win rate on bids that we're responding to. Does that cover the question?
Yeah. Is there another question from Mazin? Is the way clients are billed for your services changing? In the past, there were these were lost within an elevated energy rate.
Yeah, so I think there's kind of if you look at a SME market business where basically there's lots of price comparison businesses that are providing services to what I call the SME market. So your kind of fish and chip shops, takeaways, small offices, laundrettes, that sort of thing. And those businesses would be in a situation where they're providing a broker service and they're effectively uplifting a supplier rate effectively. In the corporate space, it operates a little bit differently. So ultimately, generally for most of our customers, they've got a kind of menu of requirements, and we're meeting that from a kind of menu of services. So from that point of view, there's a process, whether it's by formal RFP or just by proposal, a process of saying, we're going to give you these deliverables, this is how much it's going to cost. And once that's all agreed, we have a choice about how we recover. So we can either recover the monies then from the client in terms of a monthly invoice, or we can recover those monies from the supplier by the unit rate. why did that kind of arise as customer practice over the industry over the years? Well, for large customers who have got to allocate the cost for our service across 600 premises, if actually we can add that to the unit rate in an explicit way, then clearly they can allocate that cost without any administration effort. So it made a lot of sense for them, and it made a lot of sense for us, because rather than having to have a large blue chip organisation who might be pushing us out to 90 days payment terms, we can recover that money from the energy supplier. It's a much more simple process and shorter payment terms. I think kind of what we've seen as a result of the pandemic is that custom and practice evolving, it didn't account for the potential of a global shutdown society. And so from that perspective, what we find now is that we're moving much more to a kind of returning to we'll just invoice the clients directly. So we take away any impact from effectively consumption in that part of the equation. But that's not a case of previously it was lost in a rate. It's a case of there was a conscious method of recovery. It's just that conscious method of recovery is found wanting in a world once you adjust for the potential of COVID.
Question from Sebastian. The investment in software has been increasing in recent years. It was 2.2 in the first half of this year. Is this run rate going to continue going forward? So the answer to that question is yes. I guess Mark can kind of just elaborate on some of the software stuff we've already touched on.
Yeah, so I mean, I think, guys, the key thing is, as we mentioned earlier on in the presentation, energy has been a technology laggard for a long period of time. And there's lots of companies out there trying to come along with new technology and disrupt and that sort of thing. And the reality for us is we kind of have to stay ahead of that. And fortunately, as a player of scale in the market, we have the opportunity to deliver or apply more firepower to that than our competition. So in terms of what we're really focusing on, we're focusing on making sure we develop these tools and applications which solve the challenges, both existing and, if you like, the up and coming challenges for those corporate consumers. And I guess at a certain point, we'll have exhausted all those. But I would say for the next couple of years, we're seeing a pipeline of development opportunities which will keep us busy for that duration at a current level of investment. What I tend to say when people ask me about this is a way to think about it is our meter points and our units of opportunity, they're a bit like our coffee shops. So if you're in the coffee shop business and you've got the new cool hip coffee shop in town, if you don't continue to reinvest in it, eventually you're no longer the cool coffee shop. From our point of view, it's very hard to use the word cool in relation to energy meters, but I guess the reality is that if we don't reinvest in the services that we're applying to our units of opportunity, these carbon emission points, then eventually you don't become the cool solution in the marketplace. So that technology investment's a key underlying staple for the business. What we love about it is we get double bang for our buck. So we have to spend this money anyway to provide our technology-enabled service. We get to extract an additional rent from it from our customers, our SaaS customers in our software division.
Great stuff. A further question for Sebastian on cash tax rate. So I think we've seen some movements in this over the last few years. I think it's right to assume 21 and 22 financial year ends be kind of circa 18% pre the corporation tax return increase rate in 23 and beyond as things currently stand.
Mark, Paul, thank you. You have picked off every single question we've had from investors, so thank you to the investors as well for submitting those. And if any further questions do come through, of course, the team will have the ability to review those. We are just coming up to time, but Mark, perhaps I could just ask you for a closing snapshot before we conclude and redirect the investors to give you some feedback, please.
Yeah, so we've all seen with COP26 and what's out there in the world at the moment that the theme of net zero carbon and ESG is becoming prevalent in the marketplace. We're not an aspirational business that's conceptual on this, that's not making any money. We're strongly cash generative and a business that really speaks to these themes in a relatively pure way. So if someone is looking for exposure to these exciting market opportunities, then we would like to think that Inspired PLC, as a green economy mark stock, is ultimately well placed to deliver on that investment thesis.
That's fantastic. Mark, Paul, thank you again for updating investors today. Could I please ask investors not to close the session, as we automatically redirected for the opportunity to provide your feedback, and all the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. So on behalf of the management team of Inspired PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.